Warren Buffett's 6 mantras. The real game of investment is won with patience. A man at the age of 95 is teaching the world even today that money is made not by running fast but by staying at the right place. New tips come every day in the market, new stocks shine every day, and every day someone or the other says, just buy today, life will change. But fear begins right here. What if every shining thing is not an opportunity but a trap? If your hard-earned money gets stuck in some such decision which you had taken without understanding, then the dream of becoming rich can slowly become stress. And the curiosity is how Warren Buffett, after seeing that very market where lakhs of people lose in fear and greed, made such a big wealth? Did he have some secret formula, or did he just not leave some simple rules for his entire life? The story begins with a boy from Omaha who had a strange interest in numbers, business, and investing since childhood. Other children were happy in playing, but Warren Buffett was trying to understand how $1 can increase and become many dollars. He started buying stocks at a very young age indeed, but his real thinking was formed when he learned value investing from Benjamin Graham. Graham taught him that a stock is not a lottery ticket, but a small part of ownership in a business. This very thing became the base of Buffett's entire investing life. He did not see the market like red-green lines moving on a screen. He saw the market like a world of businesses, where real money is made with patience, understanding, and discipline. Today, Berkshire Hathaway is a very big conglomerate, inside which come insurance, railway, energy, manufacturing, retail, and many types of businesses. But in its root, there is no complicated magic. Rather, there is that same old question: will this business earn money in the coming years or not? Buffett was not called the Oracle of Omaha because he would tell the exact direction of the market every time. He got this name because he would recognize the basic truth even amidst the noise, and when the rest of the people ran, he could sit calm. His first mantra is to understand cash, but do not make cash God. A common man often thinks that if money is lying in the bank, then it is safe. But in the long term, inflation can slowly eat the purchasing power of that money. Buffett does not consider cash completely bad. Berkshire even today has a very big cash and treasury bills reserve. But this cash is not money hidden out of fear, rather it is dry powder waiting for the right opportunity. This means that an emergency fund is a different thing, and keeping money idle for life is a different thing. Cash is necessary for running the house, medical emergency, and a few months' safety, but to make wealth, money should be invested in productive assets. Right here, a common investor makes a mistake. He either misses the opportunity by keeping the entire money in cash, or gets panicked in an emergency by putting the entire money in the market. Buffett's balance says, keep safety too and search growth too. The second mantra is, invest in such assets which produce something. Buffett has liked such businesses which can make cash flow year after year, can give customer value, and can increase their earning power with time. Understand this in simple language. If you buy a field, then you should not fix its price just by looking at the land. The real question is how much crop that field can give in the coming years. Similarly, a company does not become a good investment just because its stock price is increasing. The real question is what the company sells, why the customer buys it, how the profit comes, and whether this business will be able to survive in the future or not. For a long time, Buffett showed interest in Coca-Cola, American Express, Apple, and many such businesses whose products and customer behavior were easy to understand. For him, a big name was not enough, a big and sustainable business model was necessary. This mantra forces one to think upon gold, crypto, fancy trends, and rumor-based stocks as well. An asset does not become valuable just because people are expecting its price to increase. It is necessary to understand it, know its risk, and fix its role. The third mantra is, recognize your circle of competence. Buffett has been saying repeatedly that an investor does not need to understand everything. But the thing which is not understood, investing money in it, just by looking at the crowd can be dangerous. Circle of competence means the scope of your understanding. If you understand the banking business, then analyze banking. If consumer brands are understood, then study them. But do not buy a tech stock just because everyone on social media is talking about it. This rule can look very boring, but in long-term investing, this very thing protects. Many people invest money just out of this fear that the opportunity might get missed. But in Buffett's world, a misunderstood opportunity is more dangerous than a missed opportunity. Your scope can be small, there is no shame in this. The real shame is when a man does not know his limit. In the market, money often goes from that investor who is more confident but holds less understanding. Therefore, Buffett's mantra says, understand first, then invest. Read the company's annual report, understand the revenue model, see the debt, understand the competition, and ask yourself that if the market closes for 5 years, would I want to remain the owner of this business? The fourth mantra is, see value before price. The price of a stock changes every day, but the real value of a business does not change so fast. The market runs with emotions in the short term, but recognizes earnings and quality in the long term. Value investing does not mean buying a cheap stock. Cheap can sometimes become even cheaper if the business is weak. Value investing means buying a good thing at such a price where the possibility of future return is understood. While buying a stock, Buffett thinks as if he is buying the whole company. If the whole company is to be bought, then no man will take a decision just by looking at today's chart. He will see management, profit, debt, competition, and future demand, everything. A retail investor also should adopt this very thinking. Whether the stock price is 100 rupees or 1000 rupees, this alone is not important. What is important is, how much is the earning power of the business behind that price and at what margin of safety you are buying. Margin of safety means keeping scope for mistake. Because no matter how smart the investor is, he cannot know the exact future. If you buy much above the fair value, then a good company also can give a bad return. The fifth mantra is, if a big opportunity is received, do not play small out of fear. Buffett does not do much trading, but when he sees a big opportunity that can be understood, he is decisive. This is a combination of patience and courage. There should be no misunderstanding here. A big bet does not mean blind risk. A big bet is only when you've understood the business, understood the valuation, seen the downside, and still the opportunity is looking in your favor. Many investors do the opposite. They put big money in risky stocks without understanding, and when a truly good opportunity comes, then due to fear they put a very small amount. The result is that losses remain big and gains remain small. Buffett's thinking says that many opportunities are not needed in life. A few right decisions with the right size can make long-term wealth. But for that you should know how to avoid noise and wait. This rule is equally important for business owners too. No need to run after every idea. But when some such product, market or customer segment is found which you truly understand, then a big result is not received from a half-hearted effort. The sixth mantra is, invest in yourself. Buffett has been saying often that your biggest asset is you yourself. The stock market can crash, currency can weaken, but no one can snatch your skill and character from you. If you improve communication, learn writing, understand sales, learn to read numbers, then your earning power increases. And the increasing of earning power is the biggest step before investing, because only he can invest who has a surplus worth investing. Many people run behind increasing the return, but do not work on increasing the income. If your salary, business income or skill income is not increasing, then you start expecting a miracle from the market. Buffett's path says competence first, then capital. In self-investment, reading books, learning from the right people, writing mistakes, taking care of health, and making emotional control are included. An investor does not win just from a spreadsheet, he wins from his behavior. In the market, the real enemy is no one else. Often it is our own fear and greed. When the market falls, we start selling. When the market climbs a lot, we start buying. Buffett understands this emotional cycle as just the opposite. His biggest strength perhaps is not stock picking, but temperament. Temperament means maintaining the right thinking even under pressure. Seeing numbers when the rest of the people are in panic. Remembering risk when the rest of the people are in greed. Buffett's investing philosophy also teaches us that activity and productivity are different things. Buying and selling every day can look active, but wealth is not always made from activity. Many times, doing nothing also is an intelligent decision. In today's time, this point is more necessary. Social media apps and instant alerts have made investing like a game. The price changes every second, and the investor feels that he has to react immediately. But Buffett's method is slow. He says, understand the business first, then do the valuation, then wait. Act if the opportunity comes. If the opportunity does not come, sitting in cash is not a weakness, it can be discipline. Berkshire's big cash reserve shows this very thing. Such a big investor has money, yet there is no hurry to buy at every price. Its lesson is not that you also keep only cash, but this that you respect price and opportunity. There is one more big thing. Buffett has been considering his shareholders as partners. He did not try just to give a return, rather he tried to build trust. In his letters, mistakes were also often accepted, which is a rare quality. In investing, honesty is a very big thing. If you do not speak the truth to yourself, then the loss hides early and bursts late. Holding on to your wrong investment out of ego is equally dangerous as selling a good investment out of fear. In Buffett's life, the role of Charlie Munger was also important. Munger gave him the thinking of moving ahead from just cheap stocks to buying great businesses at a fair price. This shift became a very big turning point in his investing journey. This means that just buying cheap is not enough. Quality, durability, and management also matter. If a weak business is found at a discount, it can be a trap. If a strong business is found at a reasonable price, it can become a compounding machine. Compounding is the quietest but the most powerful character of Buffett's story. Compounding does not make noise. It does not make a headline every day. But if money remains invested in the right asset for years, then a small principle also starts taking a big shape. The problem is that compounding needs time, and a human needs quick results. This very mismatch makes many investors weak. They want a miracle in the first year itself, whereas wealth is often made in decades. Buffett did not leave his process for decades. Market crashes came, bubbles came, technology kept changing, economy kept changing, but his base remained the same. Understand, see value, keep safety, and think long term. Today, when AI, crypto, electric vehicles, defense, renewable energy, and new themes are creating excitement in the market, Buffett's thinking becomes more necessary. The theme can be good, but every company is not a good investment. The investor will have to ask questions. Is the company earning money? Is the debt under control? Is the management trustworthy? Is the valuation reasonable? Am I buying this just for the trend or for the business? This very question separates you from the crowd. Because the crowd reacts seeing the price, the investor decides seeing the value. The crowd reads the headline, the investor reads the balance sheet. The crowd fears, the investor prepares. Buffett's simplicity should not be underestimated. Simple does not mean easy. Following simple rules for decades is very difficult, because in every cycle the market tempts you to break the rules. When the market is in a boom, then discipline looks like foolishness. When the market falls, then patience gives pain. But that investor alone survives, who can handle his process in both seasons. If you want to apply Buffett's 6 mantras in your life, then start with small steps. Keep an emergency fund, then invest the saved money thoughtfully in productive assets, and buy only that which you truly understand. Before buying any stock, try to explain its business in your own words. If you are not able to tell in 2 minutes how the company earns money, then perhaps study is left yet. Do not buy when the price falls just because it is looking cheap. And do not buy when the price increases just because everyone is making money. In both conditions, keep business quality and valuation in the center. Before taking action on a big opportunity, preparation is necessary. Make a watch list, read companies, understand valuations, and do homework in the quiet time of the market. Because when panic comes, then learning does not help, decision helps. Make investment in yourself a daily routine. Reading for 30 minutes every day, understanding personal finance, improving communication, and reducing impulsive decisions will strengthen your mindset before your portfolio. Remember, Warren Buffett's story is not just a story of becoming rich. It is a story of control. He did not control the market, but he controlled his behavior. And in investing, this is the most difficult job. Every investor will have to understand that no mantra gives a guarantee. Risk will remain in the market, losses will happen, mistakes will happen. The difference is just this, that a disciplined investor learns from a mistake, whereas a careless investor repeats the mistake. Buffett's 6 mantras in the end come and meet at one place only. Consider cash as a tool, choose productive assets, stay in the scope of your understanding, see value before price, become decisive at the right opportunity, and keep making yourself better continuously. If you adopt these principles, then perhaps you will not become Warren Buffett, but you can certainly become a better investor than before. And the biggest goal in investing is not to become a copy of some legend, but to become a wise owner of your money. Because real wealth is made not just in a portfolio. Real wealth is made in that peace, where you know that your money is running not by fear, rumor, and greed, but by understanding, patience, and discipline.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business And also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.